This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Judd and this is Talk Your Book, and today we're joined by Angelo Del Borrello from Acure Asset Management. Angelo, thanks very much for coming on the show.
Thanks very much, Chris, for having us.
Now, we're going to do a broad-based sort of overview of the Australian property sector, but I thought before we get into that, we could walk through Acure Asset Management and what your guys' business structure is.
Yeah, thanks, Chris. Look, Acure Asset Management's been going for over 10 years. We're a property funds management and syndication group. We typically we're agnostic on looking at property. We tend to focus a lot on trying to find undervalued assets across Australia, and very much in the commercial, retail, industrial, accommodation type space. So very income focused. So we typically put syndicates together to buy assets, and then we manage them on behalf of a number of investors throughout Australia. Currently, we look after about 500 million of real estate nationally.
And we'll dig in deeper into specifics in a second, but in broad brushstrokes, what's your sort of overall helicopter view of the commercial property market leading into 2023?
Yeah, look, it's obviously been an interesting year in 2022 with interest rates aggressively growing from emergency levels. And, that will affect valuations on some assets. And, we're seeing a bit of a softening in valuation through this year. I expect that to continue into early 23, which, from our point of view, sort of creates opportunity to look at assets that are, probably a bit more attractive on valuation, which have been pretty hard to find over the last couple of years.
And we've seen significant interest rate rises this year, as you touched on. What do you think interest rates will do in Australia next year?
Look, I think being pretty close to the end of tightening, I think. Obviously no one's an expert in interest rates, and only the Reserve Bank know where they're going, but maybe
well, even they didn't know where they were going either, did they?
No, well, that's right, exactly. So I don't know who's an expert in this area, but my gut feel is I think maybe another quarter, maybe a half in the new year, but that should just about do it.
And zeroing in on retail properties, where are you seeing opportunities in that space at the minute?
Yeah, look, retail's been interesting. It's particularly neighbourhood retail where you've got a supermarket anchor. It has been one of the darlings over the last couple of years. I'd expect that to continue because there is a bit of secureness in income flow through having those anchors of the Woolies and the Coles and the IGAs of this world. So, but they did get to cap rates in the fours. I think you'll probably start to see them getting back to probably, the better assets, the 5.5%, 6%, maybe a little bit softer.
And regional retail properties have performed quite strongly over the last year and a half. Is that move where work from home's enabled more people to live in the regions? Do you think that sort of strength is going to continue, or do you think we're going to go back to a pre-COVID world?
Look, I think eventually, my feeling is most employers would like to see their employees back in the office because of the collaboration and the learning that employees gain by being around other people. However, there are some roles which certainly can be taken on a work from home basis more often. And there's no doubt, the shopping centres in the regions have benefited from that over the last couple of years. Some of the shine will come off that, I think, but if you're talking, country type centres, I don't think that'll change too much because typically there's only one centre in most country towns. So I think it'll continue in the main.
When you look at that, you mentioned that a lot of those country retail shopping centres, there's one centre and there's just not the population to support another centre being built. Do they carry some monopolistic type characteristics that suburban retail centres don't, where there's enough population to obviously build multiple retail centres in a smaller footprint?
Yeah, certainly in some towns, that's absolutely correct. And particularly now where construction costs have gone up significantly over the last 18 months, I think it'll be more difficult to make a second centre work in some regions. So certainly there are some monopolistic type advantages with shopping centres in certain regions.
And talk to me about office space. Which sort of areas in Australia are you seeing as the most attractive for office space investing?
Yeah, look, we took a bit of a counter-cyclical view on office the last couple of years. We've bought 3 office buildings in the last 3 years through COVID. With all the negative talk about office, we are a believer that over the long term, office will still be important in some regions. We've bought 2 office buildings in Adelaide where we think there's some quite good advantages in Adelaide. There's no stamp duty when you acquire assets in Adelaide, which is attractive. And we've also just recently bought an office building in July in the Gold Coast, which, post-COVID has benefited from people who had taken a bit more of a lifestyle approach to the work basis and have moved from particularly regions from Melbourne and to a lesser degree Sydney.
And I won't get you to divulge your trade secrets around incentives, but broadly speaking, what type of incentives are landlords expected to pay to a high quality tenant for a 10-year plus lease at the minute?
Look, I think incentives play a pretty important part in getting tenants in buildings, and one of the major reasons for that is that to fit out an office floor, say 1,000 square metre floor, probably costs you about $1,000 a square metre. So most tenants don't have the balance sheet or the credit facilities with their banks to just fund a fit out. So typically get lands to the landlord to do that for them. And effectively we work that out on a percentage of incentive on the rent they pay. So when markets tighten, the incentives are similar. They'll still be 20 to 30% to help fund fit outs. However, what you tend to see is the face rent, we call it face rent, the rents will be going up on a per square metre basis. So, that typically, I don't see that changing too much because of, obviously the landlord has the benefit of owning the real estate and we can use our security, if you like, to assist in funding fit outs, which ultimately when the tenant leaves, lands back to the landlord anyway.
And what sort of vacancy rates are you seeing in office in the major cities across Australia?
On average, most of them are circa 10 to 12%. There's a couple of outliers in Perth. Vacancies are around 15%. But majority of them, and probably Darwin, which is a smaller market, it's around 17%. But most other major capital cities are around the 10 to 12% mark.
And what did you see from corporates? Did you see them take the sort of changes post-COVID to an increase in working from home to permanently downsize their footprint, or if the way they set up their offices just changed? Or what are you seeing from most?
Yeah, look, there was a real push before COVID for, what we call, where tenants would be looking to won't have a permanent desk, and effectively, most corporates might have allocated 70% of their workforce into an office space, allowing for people to work from home, taking time off, etc. And your larger banks, your big mining companies, your big corporates typically went down that path. When COVID hit, that became a real problem because they didn't have enough seats and or space, because typically as part of that, to reduce their costs of occupancy, they normally have one person per 8 square metres is what they got down to. Within an office space. 10 years ago, it probably was more like 1 per 14 square metres. And I think we'll probably see that one person per 8 square metre area in an office space probably expand back out to about 1 to 12 square metres, I think. It will take a bit of time for corporates to readjust because a lot of them would be locked into leases. So, we've seen a little bit of that with some of the players where leases have come up for renewal, but because they took that aggressive stance pre-COVID, I don't think it'll change a lot on that basis.
And I know every employer is different, but is the default position now sort of 3 days in the office, 2 days at home? Do you think for most employers that's standard operating procedure at the minute?
I think you probably got to divide it by big corporates to small small business. I think small business is probably, you know, trying to get people back 5 days a week. And certainly there's always flexibility, I think, in small business where people can take time off, you know, people are sick or kids are sick or whatever it might be. That's always been there anyway. I think the big corporates are probably, being that we've got a very tight employment market at the moment, are probably trying to tighten processes, but probably 1 to 2 days a week is probably the norm for some of those larger groups, I'd say.
And the last sort of property sector I wanted to dig into was industrial property, which has had an amazing run, and it's probably the one sector in property where it seems like just about everyone's bullish on it, with the the increase in online spending and the amount of logistics that need to be transported around. Is it hard to find value in the industrial space currently?
It certainly has been. I think there's been a lot of money thrown at industrial over the last couple of years, and that online sort of drive. I do think, though, it's not without risk. A lot of distribution centres these days are highly technology driven, and technology changes. So I do think that, you know, if you've just got a distribution centre that is ideal for today's climate, in 10 years' time it might not be. So I do think it doesn't come without risk, and you've got to have your eyes wide open. I do, with interest rates going up, we are seeing that sector soften with every other sector, but certainly not to the same extent as some other sectors might be.
And are there any cities that offer up more compelling industrial property opportunities at the minute?
Look, I think the smaller cities, Perth, Adelaide, Brisbane, probably offer up a little bit more value. Sydney and Melbourne, being the larger cities, are always the first to go to, and there's a lot of competition looking for assets in those two larger cities. So we've typically played in a lot of the smaller cities because you find a little bit more value when it comes to looking for assets in that sector.
And in industrial property, when you look at it, are you really looking at to eventually be rezoned and turn into resi, or that the growth opportunities having such a land parcel present, or are you usually looking at it through the lens of a cash flow asset, much like you would with an office space?
Look, I think there's a lot more, I tend to describe industrial property as a land bank with cash flow.
Yeah.
So, I do think over the long haul, land goes up, and, the longer you've got income coming through and the longer you hold, the better you'll do. So, the improvements on industrial land typically are a lot less costly than, say, an office building or a shopping centre. So we tend to look at it from that lens, but we're also very focused for our investors to generate, 7, 8, 9% income streams that we can pay out as distributions.
What other things do you look for, particularly with industrial properties, when you're looking through a deal? What are some of the things that initially catch your eye to stand out to make you want to dig a bit further into the deal?
Look, I think, probably at the moment, if we're looking industrial, we'd probably look at shorter term lease type industrials where there's an opportunity to renegotiate a new lease. We've had some success in that area. We just sold an asset we bought 9 years ago. Only a small asset at 8.6 mil. We just sold it for 16 million. We had 1 year left on the lease, negotiated a new 15-year lease at a higher rent, and our investors have benefited by having 13% distribution yields over 9 years and doubling their money because we've just sold it. So I think those opportunities exist at the moment because there's quite strong rental growth happening in industrial right across the country.
Well, Angelo, thanks very much. We don't have a heap of property guys come on here, but great to get a feel and an update for what's going to come down the pike in commercial property in 2023. Thanks very much for coming on the show.
Thanks very much, Chris. Before we leave, I might just put a little plug into a sector we quite like post-COVID, which is the hospitality sector.
Yeah.
We are in the process of buying 2 hotels in Perth that are accommodation hotels on pretty good returns. So we sort of see that as a bit of a counter-cyclical rebound sector, which we're looking to try and add a few more assets in 2023.
And is that almost an opening up type trade now that tourism's going to flow in a little bit more back into Australia and business travel's going to open up? Is that part of the thesis around those purchases? Yeah,
certainly what we're looking for is tourist type assets that are attractive for local travel in its own regions. I mean, in the case of what we currently have, Mandurah and Fremantle in West Australia, are both very attractive options locally. And we see that being a core of our thesis that we're looking for, with interstate and international travel increasing, that being the cream on the cake, I suppose. We're still not quite seeing international travel at levels pre-COVID because of costs of travel. And I think as that gets closer back to normal, which might take 12 months to 2 years to get back to normal, we do think that'll open up very strongly. I think every man and his dog wants to travel at the moment. It's a question of where they can afford to travel. And I think that's why we're looking for these local travel type destinations.
And if people want to find out more about Acure Asset Management, where should they go to head out?
Yeah, so they can certainly go to our website, www.acuream.com.au. You'll see opportunities on that website, and or they can contact us on 08 9322 5448.
Beautiful. Thanks, Angelo. Thanks very much for coming on the show.
Great, Chris. Thanks for having us.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.